Hello, everybody, and welcome to our webinar. Please understand that today's webinar is going to be a little different. We are focusing on the new Main Street lending program, and today's focus will not be on the PPP or EIDL like other programs. The purpose of this webinar is to explain the Main Street lending program, and we will incorporate PPP, EIDL, and Main Street into further webinars. So let us begin. Please post your questions in the Q&A only, and we will take them. The moderator will help sort through them after the presentation. The recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com after the presentation. And later in the day, we will email a copy of the slides and the recording to the participants. Briefly about myself, I'm Ami Kassar, founder and CEO of MultiFunding. I'm an Inc. columnist writing regularly on business lending issues. I've advised former administrations about the business credit markets. I have a book out called The Growth Dilemma. And for my EO friends out there, Entrepreneurs Organization, I'm a board member of EO Philadelphia. But you're not here to hear about me, you're here to learn about the different programs, and particularly today, the Main Street lending program and how it can help you. So let's begin. Some disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education and check in regularly as information continuously updates. The information provided is based upon our best judgment about what we know at this time and a decade of experience with SBA lending. However, key questions remain how to implement many of these programs we are discussing. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. So, what is the Main Street program, lending program? It is a program that the Federal Reserve and the government and CARES Act has allocated $600 billion in loans for. There are two different lending facilities, one for new loans and one for expanded loans. Business can obtain if you qualify for financing from one, but not two of the facilities. To participate, you must have as many as 10,000 employees or as much as $2.5 billion in 2019 revenues. This is definitely meant for bigger companies. However, small businesses, including those who participate in the PPP, are also able to seek loans from the Main Street lending program in some instances. The minimum loan size is $1 million, and how you qualify depends on which program you go for. This program is designed for companies that were doing well in 2019. If you did not make money or have positive EBITDA in 2019, you are not going to qualify for this program, and it is not for you. You have to choose between this program or issuing a new security through the primary market cooperative credit facility that is for much bigger businesses. And let's be clear that this program is in its early days and still open for comments and guidance. Final details of what we're proposing today could change, but what we are sharing with you is the outline of the program and how it is intended to work. So we're going to cover the new loan facility, the expanded loan facility, share with you some comparative examples, and talk to you about how MultiFunding might be able to help you with this program. Let's dig into the new loan facility. Eligible lenders are U.S. insured deposit institutions, U.S. bank holding companies, or U.S. savings and loan holding companies. There will be no fintech companies or credit unions participating. I shouldn't say credit unions for sure, but this is not open to non-bank lenders. To be eligible, businesses with up to 10,000 employees or up to $2.5 billion in 2019 annual revenues. You must be a business that is created or organized in the United States or under the laws of the United States with significant operations in and most of its employees based in the United States. You may not also participate in the MSELF or the primary market credit facility, but you can participate in PPP. So Some borrowers who are eligible and are participating in PPP can also participate in the Main Street Lending Fund. What are these loans? They are an unsecured loan with a 4-year maturity. The amortization of principal and interest is deferred for 1 year. The adjustable rate is the cost of bank funding, which is basically nothing today, plus 2.5 to 400 basis points, depending on credit risk. So these loans, interest rate will be roughly 2.5 to 4%, and the minimum loan size is $1 million. The minimum loan size, and this is confusing, so we will dig through it in some examples in a few minutes, is the lesser of $25 million, or an amount when is added to your existing committed and undrawn debt does not exceed 4 times the borrower's 2019 earnings before EBITDA. There are no prepayment penalty, that you can prepay these without penalty, and there's an origination fee of 1% on these loans. So let's dig in. Here's an example. Let's say on the first line, if you have in 2019 $500,000 of EBITDA and existing debt of $500,000, the maximum loan you might be able to get, it would be $2 million, which is 4 times your EBITDA. However, because the $2 million, you deduct the $500,000, in this scenario, you could be eligible for a $1.5 million Main Street loan program. Another example is a business with the same EBITDA, about $2 million worth of debt, and they would not be eligible for any debt because on the new program, because the amount of existing debt and amount of leverage they have for a company with EBITDA of that size. Remember that existing debt includes committed and undrawn components of lines of credit. As an example for a slightly bigger company, if a company had, let's use example number 2 by example, $1 million of EBITDA and $2 million of existing debt, their maximum that they could borrow if they had no debt would be $4 million, but you would deduct the $2 million, and that company could now borrow $2 million under this program. Another example, again, for a highly leveraged company, if that $1 million EBITDA company had $4 million worth of existing debt, they would not be able to borrow any money. Example number 3 is for an even bigger company with $2 million of EBITDA. And to keep it simple here, we'll take the third scenario. That company had EBITDA of $2 million, existing debt of $6 million. They would be able to borrow $2 million, which is the difference between their not to exceed 4 times EBITDA and their existing debt of $2 million. One super simple scenario for a smaller company that might be able to qualify for this program is if you had with $250,000 of EBITDA and 0 debt, you would likely be able to borrow up to $1 million and still qualify for this program. What are your required attestations for this loan? You must commit to refrain from using the proceeds of this loan to repay other loan balances. The intent of this program is to drive you to keep your business going and to invest in your business, not to repay old debt. You commit to refrain from repaying other debts of equal or lower priority, except for mandatory principal payments, until you have repaid this Main Street loan in full. And you will not seek to cancel or reduce any of your outstanding lines of credit with the lender or any other lender. Again, this is designed not to give you a chance to refinance your old debt. It is designed to give you the opportunity to invest in keeping your business going and hopefully invest in the future. You attest that the financing is required because of COVID-19. You attest that using the proceeds of the loan, you will make all reasonable efforts to maintain payroll and retain your employees during the term of the loan. You attest that you meet the EBITDA leverage conditions, and you will follow the compensation, stock repurchase, and capital distribution requirements that apply to direct loan programs under the CARES Act. This program is not intended to let you repurchase stock, increased compensation, etc. This program is designed to keep your company a growing concern and expand it and grow it during the period. Now let's talk about the expanded loan facility. I just want to explain to you really what's different about this program so we don't have to go through ad nauseum the rules of the other program. What's different here is that the maximum loan size is the lesser of $150 million or 30% of the eligible borrower's existing outstanding and committed to unbacked debt. And now the criteria is 6 times EBITDA. So that sounds like a bunch of gibberish, and we'll try to break it down in some examples. What is also different is that what any collateral secured an eligible loan, whether such collateral was pledged under the original terms of the eligible loan or at the time of upsizing, will secure the loan participation on a prorated basis. So if this is an add-on loan or tranche to your existing debt, this will be secured in the same arrangement as that one is. And you must, the eligible lender must attest that the proceeds of the upsized tranche of the expanded loan will not be used to repay or refinance pre-existing loans or lines of credit made by the eligible lender to the eligible borrower, including the pre-existing portion of the extended loan. So again, let me just reiterate to you, this program is not intended to refinance debt or replenish debt. It is intended to provide add-on instruments for companies who need them to grow and expand. Let's dig into an example. If a company had $2 million of EBITDA and had $2 million of existing debt, their total amount they, in one sense, could qualify would be $12 million. However, the 30% threshold of their $2 million of existing debt knocks them out. Another example, the third one, a company with $2 million of EBITDA and $6 million of existing debt would be eligible for $1.8 million, or 30% of their existing debt. A slightly bigger company, and let's take scenario number 2 here. A company with $4 million of EBITDA and $8 million worth of existing debt could have the potential to do a tag along or additional extension of their loan of $2.4 million with this program. And for an even bigger company, and we'll take scenario number 3 here, a company with $8 million of EBITDA and $32 million worth of existing debt would be able to do a tag along or add-on loan of $9.6 million with this program. Now, how do you pick which one's for you? Well, you have to run it and analyze it and decide which one makes sense. So let's look. A company with $2 million of EBITDA and $2 million with existing debt could get $6 million under a new facility, but nothing under an existing facility. In the contrast, a company with $2 million and $8 million of existing debt could get nothing under a new facility, but get $2.4 million under an existing facility. So it requires work and an evaluation to determine which program is best for you. Next steps. Final details will emerge over the next few weeks, and MultiFunding, as we have committed to throughout this crisis, will continue to update the community as the guidance becomes clearer and more information becomes available. Meanwhile, we are offering packages to evaluate the program and to determine which facility is best for you if you think it's eligible for you, and prepare your loan program package and submit to the lender and to help you negotiate with existing lenders. Keep in mind that in many cases, part of the hard thing of this program will be dealing with existing lenders, especially if they are not bank lenders who might think that they are violating their covenants. And with that, we're going to ask the moderator to open to questions. Keep in mind that we are going to refrain, at least we want to get through the questions regarding the Main Street lending program first, and then we will try, if there's still time, if anyone has the IDL, I'd be happy to answer them. Thanks so much.
What about companies with negative EBITDA? For example, startups with negative earnings.
But not eligible for this program. You have to have been have had positive EBITDA in last year, and based on one of the programs, be eligible for a minimum loan size of $1 million to be eligible.
If it is a 4-year maturity with a 1-year deferral, what would be the best method to estimate payment schedule?
We could certainly run an amortization schedule for you if you want that, no problem. You just have to calculate in a deferment for the first year.
Can you borrow less than 1 million if the EBITDA 4 times is less than $1 million?
Absolutely not. This program is really designed for bigger companies, and the minimum loan amount will be $1 million.
Are there any other loan programs under $1 million minimum sponsored by the feds?
No, I mean, the feds are boosting the balance sheets of the banks to encourage more PPP lending, but there are no programs in the middle right now that we're aware of. It doesn't mean they might not come out in the future, but not right now.
Can you please explain how the rate variability will work and what will be the basis to the change of the rate?
Each bank will determine the rate based on their understanding and evaluation of the credit risk of business. And so that's the one thing. So you could end up at 2.5% to 4%, at least under current guidance. And then the cost of what the bank, the amount could go up as the cost of what the bank borrows money from the government goes up. Right now, that's essentially nothing, but as the recovery hopefully starts to improve, that cost of funds could start to increase and then impact your rate.
How well does your company have to have done? Is there a minimum for revenue for the ability, i.e., if you made 1.2 revenue, would you qualify?
It has nothing to do with revenue. I mean, if you have $1.01 million revenue and $1 million of EBITDA, revenue has nothing to do with it. It's all about EBITDA.
Confirming that you have a $250K line of credit facility that is undrawn. You have a $250K of debt for the purposes of this program?
Correct.
Can Main Street loan proceeds be used to pay fixed cost?
They absolutely should be able to. There should be, the only thing you're not allowed to do with it is use it to pay off this debt.
If current EBITDA is 150K and current debt is 550K, do we qualify?
I don't think so. In that case, it's 6 times, which is 900,000, or 4 times, which is $600,000. So no.
Does the existing and undrawn committed debt apply just to traditional bank debt, or does it apply to PE debt?
That's not clear in the guidance, but I'm going to assume it applies to everything.
When you talk about facility, what do you mean?
That's the facility that the government has created. So that's the loan instrument that, because there's a whole other area of how this facility, the money flows back and forth between the lender and the government, and how the government buys a lot of it from the lenders. That's what I mean by the facility.
If we have a line of credit with a bank but only utilize 50% of it, how do we calculate the debt? Presumably, we could pay down our line of credit just before we receive the funding on this program, leaving ourselves very short of money, but then levering the money instead of the line of credit. How would that be looked at?
It doesn't matter if the line of credit is drawn or not. The full amount that is available is going to count. Now, technically, if you shut down your line today and then apply for one of these, you might be eligible, but I'm not suggesting that. I don't think it's a good idea.
Does revolving monthly Amex debt get included in the debt component when calculating the loan amount eligibility? And is EBITDA calculated from the tax statement or from the internal accrual or basis income statement?
There's 2 questions there. Will be interesting to see in the guidance how EBITDA will be calculated, because most businesses, especially bigger ones, aren't anywhere close to having their year-end numbers finished, or they were just in the process of that when the coronavirus started. So how 2019 EBITDA is going to be calculated will be a very interesting point that will come out over the next few weeks. For Amex, I would imagine that that amount would be included in your debt calculation.
I have a seller note I pay a monthly interest payment on. There's a balloon payment in 2 years. Could I get this loan and still pay off the other loan?
You could get the loan if you're eligible, and the seller loan amount will be, I believe, included in your total debt calculation, but you cannot use the proceeds of this loan to pay off the seller loan.
When do you think this will be available for actual lending?
I would hope within the next few weeks.
Can the funds be used to grow the business, add a new product line?
I think that's a big part of the idea of the program, absolutely.
With EBITDA of 200K and debt of 350K, would I qualify for either?
You would not qualify for the first one, and I don't think you'd qualify for either.
What makes a company that is smaller eligible?
Again, it's all about EBITDA. Doesn't matter the company size, if you have 4 employees or 4,000 employees or 1 million revenue or $100 million of the revenue, that's irrelevant. What is relevant is your EBITDA.
We have 150K EBITDA and 1 million debt. What does that look like?
You're not eligible.
Are there any programs that we can refinance our higher cost debt?
Not at this time. I think some will come out and emerge. They will almost have to, and particularly with the SBA, but unless your business is anticipated to thrive over the next several months to a few years, it's unlikely that there are any programs. If your business is expected to thrive, and some industries are as a result of the crisis, that's a different story.
If we have existing debt, are we still eligible for a new facility?
If you meet the criteria and you run those calculations, you might be. It depends on your EBITDA and the size of your debt compared to your EBITDA.
We have a positive EBITDA of over 100K, 40 employees. We are growing into a new facility. We need a minimum of 1 million. Is that program right for us?
There's no, with 100K of EBITDA, there's no way this program is right for you, but we might be able to talk to you about a regular SBA loan if you anticipate your growth to be strong, irrespective of this crisis.
Do banks take risks on these loans?
Yeah, so the banks will sell a huge portion of them back to the Federal Reserve, but they will keep a portion of them themselves. So yes, they take some risk.
Are there any rates or other terms published yet, or did I miss that?
Everything that is published, we've shared with you.
Is it correct that the 250K EBITDA is the minimum then?
That is a minimum for a new facility, and I need to calculate, and I will share it and post it, the minimum for an existing facility, but that stipulation of that is tied to having some debt. So I have to calculate.
If a company,
Just to be clear, the 250 minimum is assuming you have no debt.
if a company has not filed their 2019 tax returns yet, can they apply?
Yeah, and that's subject to guidance. I would advise anybody, if you're close to having your 2019 tax returns ready, to go ahead and file. But I don't think it's going to be a requirement for this program. So the question will be, what are they going to accept? Will they accept internally prepared financials? Will they require some kind of compiled or audited financials? That will become clear in guidance, and we don't know yet.
How are affiliated groups handled for the loan?
No guidance on affiliation, but because the number of employees is so high, I think that the affiliate issue will not be nearly as big an issue as it is in the PPP loans, but that again will be subject to future guidance.
Are there any prepayment penalties?
No.
If we had a 1 million EBITDA, no debt, we have a line of credit capped at 3 million with nothing drawn, would we qualify?
Qualify for up to $1 million.
How will the use
Let me just be clear, you'd be qualified for up to $1 million on the new program, and you could qualify for up to $3 million as an add-on expansion program. So depending what you thought your needs were, you'd have to decide that.
How will the use of funds be determined? If we have 5 million in EBITDA and pulled 5 million through this program, that's 10 million all mixed together in our record keeping?
The use of funds are really up to you as long as you don't use the money to repay old debt.
If the bank still needs to hold 5%, why would they make the loan if it's to be stretched for them? If I need a new bank, can I refinance an old loan with them?
The bank stands to make more than 5%. They're keeping 5% of the loan on their balance sheet, and they're selling the other probably at par. They're selling the other 95% to the Federal Reserve. So the bank stands to make more than 5%. It's just they're keeping 5% of the loan.
What if you don't have 10,000 employees?
That's fine. That's the maximum. That's not the minimum.
Can we close an undrawn line of credit and apply for the loan?
I'm sure there will be some guidance about that, but as of the rules that stand today, there's no reason you can't do that, but that could change.
If you have 360K EBITDA and 359 in debt, would you qualify for anything?
Yes.
Does the EBITDA for the Main Street loan include corporate and store level expenses?
I think that will be subject to future guidance about exactly what EBITDA is included, and there might be variances for different levels of companies.
Does existing debt include any existing business debt? Are there any exclusions?
Not that we're aware of.
If we file a cash basis tax return, can we use cash basis EBITDA?
I would assume so, but again, that's subject to future guidance.
Would the interest payments on this loan be tax deductible?
Subject to future guidance.
Will existing dividends and compensation paid be grandfathered in if we tap the Main Street loan facility, or are there limits?
There are limits, and those will be explained in future webinars and presentations.
Are your credit card debt included in this debt calculations?
I would assume so, but the intent of this program is, you might slip by and that would be included, but the intent of this program is for companies that aren't worried about credit card debt. The intent of this program is for much bigger companies.
So you can borrow 4 times your EBITDA, is that correct?
4 times your EBITDA, assuming you have no debt.
If we have 300K EBITDA and 1 million of existing debt, are we eligible?
No.
Does it matter if cash or accrual or financials?
Again, it's subject to guidance. I don't think it's going to matter.
Is EBITDA debt calculated by year end 2019 or Q1 2020?
Year end 2019.
Will there be foreign ownership restrictions on applicants to this program?
No evidence of that, as there aren't in the PPP.
Is income paid to members or owners of an LLC considered in the EBITDA calculation?
Should not. That should come after EBITDA.
Based on EBITDA and debt, my businesses will qualify, but we don't have 10,000 employees. Do we qualify?
Yeah, that's the top end. That's not the bottom end.
Could funds be used to do an acquisition?
You do whatever you want with the money. I wouldn't advise doing an acquisition unless you're buying it at the bottom of the barrel on a 4-year amortization. That's a frightening way to do an acquisition, but by all indication, there's no restriction on what you can do with the funds.
Do you think affiliated organizations would need audited financials to apply for this loan?
Again, that will be subject to guidance. There are going to be some standards. It's just not clear what they will be. And the truth of the matter is a lot of companies don't have their audited financials done for 2019. And there's no way they could have had them done in time. So it's going to be really interesting what what standards the Federal Reserve comes up with for that.
Is there a minimum number of employees?
No, I have 1 employee.
If we have 333K in EBITDA and 650 of debt, would we qualify?
Yes. You guys are making me do math in my head here like a freaking magician, guys. Come on, give me a break.
It looks like we got through almost all EBITDA questions, and now I have just PPP and EIDL.
Okay, I'm happy to stay on for a few minutes and give any updates or answer any questions on the PPP or the EIDL. If there are folks who are not interested in that program, you're welcome to log off, and we'll be sending this out to you later in the day. But let's go ahead through those questions. That's fine. And I see there's a bunch of stuff in the chat. Are you being able to get to that, or are you only doing the Q&A?
I was doing the Q&A, but I can get to the chat right now.
Okay. We'll just flip through the chat quickly to see if there are any Main Street lending programs questions in the chat, and then we'll go to the PPP and the EIDL.
Can you borrow less than 1 million of the EBITDA 4 times is less than 1 million?
No, the minimum loan amount is $1 million. They won't lend you less than $1 million in this program.
If I buy a new facility, it is a 5-year amortization, correct?
No, these loans amortize over 4 years. And so if you're using it for investment purposes, you have to keep that in mind. And unless you're buying things literally at the bottom of the market and you feel fully safe, you can pay them off over 4 years. It's probably not the best use of this type of loan.
Are there any programs available to refinance higher cost debt?
These programs are not intended to refinance higher cost debt. I imagine that some programs like that might come out in the future over the next few months, but that is not the intent of this program. You cannot use it to refinance existing debt.
Is there a personal guarantee requirement?
No.
We have 500K EBITDA and 2.2 in debt. I think I'm only eligible for expanded loan facility, correct?
Yes. I believe so, but I did a lot of math in my head there quickly, but I think that's the case.
When calculating eligibility, do you get credit for SDE or add backs, or is it calculated strictly off your tax returns?
Again, it's going to be super interesting because most tax returns just aren't done. So although I would recommend if you're close to getting your tax returns done, you get them done. So I think there's going to be up to a lot of interpretation based on how it's calculated.
Are there limitations on distributions, and how does that work for tax payments for pass-through companies?
I know there will be limits on stock dividends and stock buybacks. in terms of distributions, be subject to guidance, but I can't imagine that there'll be limits on distributions that don't let you pay your tax obligations.
In terms of outsourcing restrictions, if we have an existing outsourced workforce in a place, are we able to retain such people? What are engaging new offshore staff who are not replacing existing onshore workforce?
Yeah, that's going to come forward in the guidance, and it's not able to answer that question intelligently right now.
All right, here's some PPP. Does the PPP and EIDL?
Just now, we're going to flip now to PPP and EIDL just for, I'm going to be able to take 5 or 6 questions and then I have to wrap up, but we'll just take a few of those and then we're going to wrap up. So let's go for it, Hannah.
If we have applied for the PPP but not yet heard back, can we also apply for the Main Street loan?
Absolutely.
If my company is owned by a UK company, are we eligible for the PPP care loan?
Yes.
If you take a loan for PPP, will that debt be included in the calculation as well for the determining total loan amount?
Our assumption is that it will be.
Does the PPP and EIDL count as debt in the calculation?
We assume that it will.
Will the PPP loan be considered in the calculation, or are we only using the December 29 debt?
Subject to future guidance, but I believe it will include all current debt, and then the PPP will be included. It'll be really interesting to see what they decide about that, because in theory, the vast majority of the PPP should be forgiven.
In regards to the PPP, how long can we defer receipt of funds once the loan has been approved?
No, you can't. So it's pretty much as soon as the bank is willing and able to give it to you, you have to take it. That's not the intent of the program, guys. The intent of the program is to get the money, get your people back on payroll, even if they're sitting at home doing nothing.
What's the distribution guidance?
Subject to future guidance. So, folks, we were expected to go actually 12:40, and I have another obligation at 12:45 to wrap up. There will be more information and more details forthcoming about the Main Street Lending Program. In addition, just to let you know, if you want some of our packages, we have the ability to help you evaluate the program and determine which facility is best for you, and to prepare your loan package, submit to the lender, and negotiate with existing lenders. And if you think you're eligible for this program and you want to talk to that, please reach out to Megan Burns on our team. I thank you so much for your time. The webinar series is off Wednesday, but we will be back Thursday with more information. I know it's tough times out there. We wish you all God bless. Take care. Bye-bye.
Thank you.